PWC Third Annual Global Crypto Hedge Fund Report 2021, Grayscale Investor Deck, September 2021, reviewed by Mr. R. I can be found on Twitter at misstep_. Hello again, and thanks for joining. Of course, I'm not a financial advisor. The video produced by myself as a way to document my own analysis on the current marketplace, reevaluating my position and building conviction in my own portfolio. This time we'll be diving into Grayscale's investor deck and looking through the prism of PWC's Third Annual Global Crypto Hedge Fund Report. Starting with PWC, this firm is known as one of the big four accounting firms in the world, others being EY, KPMG, and Deloitte. PWC reported 34% of the revenues coming from advisory services, accounting to $14 billion USD. Here's a full list of PWC's topics covered in their report. I'll be touching on some of them, but not all. I do recommend reading the full report for yourself. Moving on to Grayscale, this is the outline I'll be using, looking at history, team, clients, AUM, assets, performance, risk management, and my closing thoughts. Grayscale first launched in 2013, well before hedge funds began to enter the marketplace, being one of the early adopters and creating a trust that put themselves in a position to capture new clients before any of the hedge funds began their own crypto investments. On the chart here, we see in 2014 was the first fund inception, correlating to the Bitcoin price. There's a huge spike in 2017, 2018, 2019, and 2020. In 2020, the average size of an investment team marginally decreased from 8.7 to 7.6 people, while the average number of cumulative years of investment management experience has increased from 50.1 to 60. This year's undermanagement may be due to survivorship bias, where the crypto fund is closed during previous years had higher proportion of junior staff. Additionally, it could also mean newer funds are being established with fewer and more experienced staff at the initial stage. When looking at the CEO, CCO, COO, the founder will often have the most experience in crypto assets. This is the case for Grayscale. Years in the crypto asset market before joining Grayscale, and the high-level C-suite executives has a combined experience of 9 years. Unfortunately, I was unable to find the COO's photo. He must be camera shy. With limited data available on LinkedIn, there are approximately 10 employees who would work under managing funds held by the trust and about 53 years of experience in investments. This would put Grayscale just below the average of 2020, but above the median in 2020. High net worth individuals, or HNWIs, are the most common investor type for crypto hedge funds, with more than half the funds mentioning them as a common investor. Family offices come in at second at 30%, the funds of funds a distant third at 4%. Although institutions have been aggressively plowing into cryptocurrency markets, they are not yet privy to investors in the crypto hedge fund. There are only one fund of example mentioning them as a main investor. The type of the top spots are dominated by high net worth individuals and family offices. The median number of investors in a fund is 23 and the average is 70.1, while the median ticket size is $400,000 and the average is $1.1 million. The graph below shows the distribution of the average ticket size, suggesting half of the funds were tickets below $500,000. Grayscale shows many of the same clients as the crypto hedge funds. High net worth individuals are defined as having an annual income in excess of $200,000 a year or $300,000 per spouse and spousal equivalent. Net worth over $1 million, either alone or together, spouse or spousal equivalent, excluding the primary residence, or hold a good standing with Series 7, Series 65, and Series 82 professional certifications. Entities must have $5 million or liquid assets, or all beneficiary owners must be accredited investors. Looking on to their institutional investors, ARK Invest, Next Generation Internet ETF ticker ARKW, has 8,074,432 shares on October 1st of 2021, which has a market value at the time of $273,319,523.20. This is approximately 5.48% of the fund. The highest held stock in the fund is Tesla, being at 10.36%. Connects Mutual is another institutional investor, having 9 different funds, pouring a total of $150,958,900 into them. The one with the largest makeup of Grayscale's stock would be the Internet Fund, where it has 28.6%. Lastly, we have individuals who would like to invest in ETFs. Unfortunately, the US does not have this and does not allow people to do such. Retail investors will have 3 options. A, buy directly into crypto assets. B, find an ETF that holds Grayscale's products, such as ARK Invest Above or Connect Mutual Fund. Or C. Look overseas for an ETF such as those set up in Canada. The theme of expansion and growth is clear for crypto hedge funds. A jump from 12.8 million end of year 2019 to 42.8 million end of year 2020. The amount of AUM, or assets under management, went from 2 billion to 3.8 billion. Concentration within the top 10 is clear, holding 65% of the 3.8 billion. New clients are likely to pick well-capitalized firms over others. While the firms mentioned before all combined the equal value of 3.8 billion, Grayscale is over 10x that, with an AUM of 43.3 billion. The clients listed for Grayscale are currently outpacing crypto hedge funds since inception. Looking at the daily trading activity of these hedge funds, they attribute BTC as 56% of their daily crypto activity trading by volume, while 50% of the funds are purely Bitcoin funds and trade only Bitcoin. When removing stablecoins and trading activity, the top 5 traded crypto assets are Ethereum at 67%, Litecoin at 34%, Chainlink at 30%, Polkadot at 28%, and Aave at 27%. As for Grayscale, the firm manages 15 products. 13 hold a single crypto asset, while 2 of them are mixed, the DeFi and Digital Large Cap Fund. The largest fund Grayscale controls is the Bitcoin Trust, having 30.8 billion. The second largest is the Ethereum Trust, having 10.5 billion. The DeFi fund inception date was July 14th of 2021. The value at the time of recording was $10.4 million. No trailing 12-month data is available. Since inception, the fund is up 24.8%. The Digital Large Cap Fund inception date was on February 1 of 2018. The current value is about 494.6 million, up 377.34%. The trailing 12-month inception, it's up 211.7%. 4 types of hedge fund strategies were identified and featured in the report: quantitative long-short, discretionary long-short, discretionary long-only, multi-strategy. Taking a look at quantitative, it obtained second place in 2019, then slid to fourth place in 2020. It's defined as funds taking quantitative approach to the market either as a directional or as market-neutral manner. Indicator strategies include market making, arbitrage, and low latency trading. Liquidity is key for these strategies and restricts the funds to only trading more liquid cryptocurrencies. As a result, the fund typically has the shortest lockup periods for investors. Next is discretionary long only. Was third place holder but took the top spot for 2020. It's defined as funds which are long only whose investors have long investment horizons. These funds tend to invest in early stage token coin projects and also buy and hold more liquid cryptocurrencies. These funds tend to have the longest lockup periods for investors. Grayscale began with just the Bitcoin Trust. Since inception back in September 25th of 2013, it has increased by 31,707.1%. The odds of a retail trader having the funds necessary to invest back in 2013 is unlikely. The clients Grayscale is looking for are people of HNWI, or institutionals, like we mentioned before. To be part of the investment pool, most of the trust requires an investment of $25,000 with 3 exceptions, being the Bitcoin Trust, Digital Large Cap Fund, and the DeFi Fund, each asking for $50,000 to enter the investment pool. But at the moment of October 2nd, 2 funds, the Bitcoin and Digital New Private Placements, into the fund are unavailable, either to too much demand or other speculative reasons. Since the trust and hedge funds have different business models and parameters they must adhere to, investment strategies vary vastly. They cannot be directly compared on the scopes, but nonetheless, a person who is a high net worth individual would be looking at the following: custody and counterparty, derivatives and leverage, liquidity, lockup, and fees. All hedge funds deploy different strategies. The overall pattern is the use of independent custodians has decreased from 2019 to 2020. Noteworthy custodial firms are Gemini, Coinbase, Aeon, and to custody, with many other options in the marketplace. Some larger hedge funds will use more than one custodian. There are many reasons for this. Some do it for counterparty risk management reasons, especially consider the increase of hacking risks in the industry. Others may require a second custodian due to the primary choice, not offering custodial services for the crypto asset they're looking to use. Unfortunately, onboarding a second custodian is not always possible for smaller funds due to the minimum monthly fees and the added expenses, which are significantly to impact their net performance. With Grayscale being a trust, it provides long-term holding periods. Selecting a custodial provider who has an established history and highly regarded is essential. Coinbase was selected by Grayscale. The firm is licensed by the money service business with FinCEN, also engaging in money transfers and transmissions in most USA jurisdictions. As for how Coinbase keeps its crypto assets, 98% of the customer funds are held in storage offline, has insurance policies of digital assets held across our storage system against loss of theft, including cybersecurity breaches. However, our policy does not cover any losses resulted in unauthorized access to your personal Coinbase account due to breach or loss of your credentials. This system would fit the requirements of Grayscale, being that they do not actively trade. The trust will generally increase the holdings of a crypto asset over time if the demand of a certain product has high enough demand. With long holding periods, it will also lock up the assets of those whom are high net worth individuals or institutions signing up. Derivatives can either be used for hedging or alpha enhancing instruments. 2020 was a very busy year in this space. Bitcoin futures open interest saw a substantial rise, indicating increased institutional interest in cryptocurrencies. As a result, existing derivative exchanges sought to enrich their offerings, while a number of new players entered the space, leaving a decrease in the concentration of trading volume distribution between exchanges. Towards the end of the year, Bitcoin futures nominal trading volumes exploded. Trading currently includes billions of US dollars per day, up to 100 millions per year ago. Data shows that more than half of the surveyed funds use derivatives, with options being the most commonly used tool at 31%. This is consistent with the extremely bullish view of the market, especially from Q4 2020 into Q1 2021, when the survey was conducted. However, in contrast with a previous survey, funds were taking less short positions, only 28%. Grayscale doesn't participate in this, as it is a trust. When looking over liquidity, lockup terms, and fees, the crypto hedge funds are largely the same, similarly requiring 1 year, but differ if the funds are hard or soft lockup. Hard lockups are where the investor is not allowed to redeem until the end of the lockup period, while soft lockups where the investor is allowed to redeem but a penalty must be paid. PWC's team found that nearly a third of the funds, 31%, use one or the other. Quant funds provide the most liquidity in fund terms, and multi-strategy funds provide the least. Quant funds trading liquidity exchange-listed crypto assets can provide better liquidity in relation to the investments in early-stage projects or multi-stage funds, where managers need to consider various portfolio strategies and instruments ahead of executing trades. On the management side, median management performance fees remain unchanged at 2% and 20%, respectively. Average management fees are also stable at 2.3%, but the average performance fees increased from 21.1 to 22.5. In comparison, Grayscale's amount of liquidity seems quite good. Some funds have had to hold off onboarding new clients. As for lockups, only 2 funds do not require a 1-year lockup. Those are the Bitcoin Trust and Ethereum Trust, which just have a mere 6 months highlighted in light blue. Lastly, fees. In red, we can see the Ethereum Classic with a 3% fee being the highest of all products listed. It's noted, in order to promote the growth and development of the Ethereum Classic network, the sponsor intends, but not is obliged, to direct up 1/3 of the annual fees of the Grayscale Ethereum Classic towards the Ethereum Classic Cooperative, whose initiative supports development, marketing, and community activities of the Ethereum Classic network. For more information, visit etccooperative.org. The Bitcoin Trust has the lowest fees of 2%, highlighted in green. All products considered, Grayscale does offer a great range of products considering the liquidity and lockup fees. When considering investment options between crypto asset hedge funds and Grayscale, 2 items come to mind: time frame and risk tolerance. Time frame plays a key role in an investor. The chart here shows the alternative of having an investment in 60/40 Classic. The 60/40 Classic Global consists of 60% allocation to iShares MSCI CIWI and a 40% allocation to the Vanguard Total International Bond ETF. The digital assets consist of an equivalent weighted mix of Bitcoin, Bitcoin Cash, Ethereum, Ethereum Classic, Litecoin, Stellar Lumis, Zcash, and Zen. With proper allocation, an investor could have just 5% of digital assets, could obtain 247% cumulative return. Of course, the data dates back to the inception of Grayscale in 2013. Regulatory. Nearly 2/3 of the respondents said that if the main barrier were removed, they would either actively accelerate involvement in investments in digital assets by 18%, with the potential change of their approach becoming more involved, 46%, while 32% of respondents stated that the removal of barriers would not provide an impact on the current approach given investing in digital assets remaining outside their mandate. When looking at the overall report crafted by PWC in the sectors covered here, approximately 150 to 200 crypto hedge funds exist today, with 81% launching from 2017 to 2020. Hedge funds experts are coming from the traditional finance background. A survivorship bias today could affect findings in the data. Firms that have dissolved couldn't be part of the survey. Fortunately, PWC's report does mention this, but doesn't attempt to provide adjustments in the data. On the sidelines are firms such as Van Eyck, Galaxy Digital, Fidelity Investments, Bitwise Asset Management, Direxon, ProShares, First Trust, and Granite Shares. All have filed with the SEC to open ETFs based on crypto assets. The SEC has been pushing back the decision date until recently. News stated that they may resolve the issue at the end of 2021. Also in play is Grayscale, whom is looking to convert their current trusts into ETFs with approval of SEC. Taking a step back, investors fall into two types: high net worth individuals or institutions. If the investor is not looking to hold crypto assets themselves, consideration of Grayscale is a given. With the high net worth individuals seeking crypto asset exposure, Grayscale's basket of products outshines any crypto asset hedge fund in terms of agreement and fees. Furthermore, comparing investment tactics, the long-term hold has proven the best which Grayscale does offer. As for institutions, they could self-storage, but this will require the need for onboarding new staff, build-out of infrastructure, and creating proper protocols for storage. This will add new costs to the business and likely not worth the investment overall, unless the institution is a FSI. Then the alternative, crypto asset hedge funds can provide clients with some ROI, but careful screening of staff, history, tactics that will be needed to implement could have a major impact on ROI. Most funds require an accredited investor, placing anywhere from $10,000 to $50,000 upfront and the lockup of 1 year in most cases, not including the fees and profit sharing that will occur along the way. To conclude with, the trust provided by Grayscale is an attractive offer. With a proven track record, team, and elected use of long-term lockups to protect holders, Grayscale has a large enough pool of liquidity in times of financial stress, holding an AMU far exceeding those funds found in PwC's report by a 10x. The scale and influence Grayscale can apply to marketplace is substantial. In addition, using proven custodial providers and insurance for the underlying asset, without question, most, if not all, investors would gain from the use of Grayscale's trust over any crypto hedge fund. Grayscale's investment product, having crafted with the anticipation and change in the occurring global financial markets, should be at the top of the list of any investor. It's been a pleasure. I can be found on Twitter at misstep_. If you want to reach out, till next time.